Hi, this is Tron Welch with Welch Financial Planning, and welcome to our second quarter economic update. I'm going to take 10-15 minutes, run through some high-level economic activity, and give you a feel for what we think the future looks like. The big three themes for today is going to be sentiment, employment is very interesting, and then the federal funds actions that are diminishing inflation. So first, let's look at a chart as our economic growth. We are basically going to get back on the 2% trend line that we've been on for over a decade. 2%, I think, is just where we're at with our productivity level and then our population growth being at near zero. 2% is probably the best we're going to do over the near term. So going into one of the big themes that I wanted to talk about was consumer confidence and just our general sentiment. We can see all the way at the left of the chart, kind of the green dot, we are not feeling very optimistic. And when we don't feel optimistic, we kind of tighten up with our spending and just generally slow down. And I kind of think this is pretty interesting because the sentiment really isn't that far off from how we felt in 2008. But in 2008, the economy was in dire conditions. Unemployment was at high levels. And it was just a really uncertain time. And what's interesting to me is that although the stock market is down, over the last year or so, really not down that bad, and unemployment is at historic lows, that I just think it's really interesting that we still feel not very confident, even though the economy is doing well and everybody has jobs. And that's just kind of the combination of, obviously Ukraine, U.S. political turmoil that's going on, banking issues that happened a couple weeks ago, kind of the pending debt ceiling, which is going to start dominating the news over the next couple weeks. So people are still spending, but they're certainly spending at a lower rate. And so sentiment is helping us control the inflationary situation that we're in. One of my favorite charts is the JOLT chart, and this is just measuring job openings. And we can see that in early 2022, job openings kind of hit a peak there, close to 12 million jobs available, which was over 2 jobs per unemployed person, which is staggering to think about that. But now we see that the JOLTS report is kind of declining a little bit, and so fewer jobs are available, still plenty of jobs out there. It may not be the job that you want, but you can work tomorrow if you're a little less choosy about what you're doing. The job opening is declining as one indicates a little bit lower economic growth as people are closing out jobs that they are unable to fill, that they don't feel they need. And a little bit of job replacement by technology. I think we're seeing that on a day-to-day basis, more technology, especially in the restaurant environment, where we're seeing more automation going on, and it's eliminating jobs on the lower level, and it's helping bring down the JOLTS report. Moving over to job creation, this is going back to basically January 2022, and you can kind of see just kind of a gentle trend. The fewer jobs are being created on a month-to-month basis. And again, this is positive in the sense of lowering inflation. I know it's not really a comfortable thing to think about, that fewer jobs are being created. But one, we don't have people to work the jobs if we do create them. And two, the job creation is an inflationary pressure. So I think we should be able to kind of, it will help reduce the inflation moving forward. But the jobs that are being created, where are they happening? It's mostly in leisure and hospitality, healthcare and government, and professional services. Certainly CPA firms are hiring, financial services are hiring. And then conversely, the jobs that are not growing and actually declining is construction, which I think is interesting, and retail trade. So moving over to civilian unemployment rate, the rate of February in this chart, unemployment dropped down to 3.6%. Some data that I looked at today has unemployment at 3.5, which is obviously one of the low points on this entire chart. In fact, it is the low point of this entire chart. And so the 50-year average of unemployment has been 6.2%. So sitting at 3.5 is pretty amazing. And we're just not going to get better than that. But the other thing that is happening is that wage growth has stopped growing. It is growing at a lower rate, and you can see the blue line taking a dip down at the far right end of the chart. And what's interesting, or what we've seen in the past, is that as unemployment has declined, pressures of wage growth have increased. And that has decoupled in this latest decline of unemployment. And that currently, the last 23 consecutive months, wage growth has been lower than inflation, which I think is really interesting because we are losing our ability to keep up with inflation, which is a little bit deflationary in its sense, but it is also impacting just about everybody's household, that they're paying more for the goods and not having the income to take care of it. So it's putting pressure on households. Moving over to the CPI and core inflation, so let's go ahead and talk about it. Inflation, peaked out at about 9%. In 22, but in January it dropped down to 6.3. February it declined again down to 6, and it will continue to decline. The banking issues that we've recently seen the last couple of weeks do complicate the future. The strategies to support the banking industry are inflationary by nature, and so now the Fed has a very difficult job trying to make sure the banks are stable but not creating more inflation. And it's actually probably an impossible spot to be, and so just time might be the only answer for that. Shifting, more towards inflation as to what's causing it and what's not causing it is when we look at the money supply, which is not a very exciting chart, but you can kind of see in January 2020, where it's a little shaded in there, a real big spike in cash available. That is obviously a lot of the COVID stimulus that went on. But then cash continued to grow all the way through, January and February 2022. And that is extremely inflationary. And obviously we're seeing that happen. But the Fed has successfully got that kind of tipped over. And now the cash supply is starting to decline. And that is reducing inflation. Another steps that the federal government is taking, or the federal bank, more accurately, or Federal Reserve System, is increasing the federal funds rate, which is the rate of interest that the Federal Reserve charges banks to borrow money. And you can see that basically between January 2020 and January of 2022, banks could borrow money for free from the Federal Reserve as they're trying to stimulate the economy. But then interest rates have moved up 4.75% in basically going from January 22 to January 23. That is not pumping the brakes. That is absolutely stomping on the brakes. And the Federal Reserve is making borrowing much less attractive, which is going to cool down the inflationary pressures. And it is working. Another area that we really see that in is the 30-year fixed rate mortgage. And this chart I think is just always fun to look at. And starting on kind of the left side, the mid-80s, a 30-year mortgage was more than 17%, which seems absolutely impossible and kind of comical. But really, mortgage rates were in double digits from 1979 all the way to 1985. So a long period of time of double-digit mortgage rates, and then they've started to decline all the way down through 2022. And then recently, mortgage rates have basically gone from 2.75 up to 7.25 as of today, and that is, dramatically increased the payments for home buyers. And so that is, for people buying homes today, they need to put down more down payment in order to qualify, which then pulls money out of the system, or their payments are significantly higher, which again pulls money out of the system. Both of those are deflationary pressures, and it's helping bring inflation down. And the last chart that I want to go through today is the personal savings rate. And this is a little bit unnerving. On the chart on the left, the right side of it, you can see kind of the blue line there. And that is the savings rate that has just fallen off a cliff in the last 2 years. So starting from 2005 to really 2020, the personal savings rate has been growing in a positive sense. So that's people saving for retirement, getting money away from a rainy day fund, and getting their household net worth building. And then really in 2021 and 2022, that has largely stopped, and now the savings rate has been cut in half, if not a little bit more. So that means that people are going to soon stop spending. And we'll see that drag on the economy, which will then bring inflation down. Moving on the right side, it's kind of the same information, but kind of tells a little bit of a different story. This is the resolving consumer credit outstanding. So now you can see that it's ticking back up for January 2023. And there's just kind of a point where people look and feel that their credit card balance is a little bit too high. And again, they slow down the spending to do that. All of the things that I talked about today will be largely reducing inflationary pressures moving forward. And we should see inflation kind of returning to that 3-4% in 2024 and 2025. So those are the major things that I wanted to talk about today. If you have any questions or you'd like to explore these topics further, feel free to give a call. I'm always happy to talk with you. Have a great day and look forward to seeing you soon. Bye-bye.